Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Monday. It's January 4th. It's the first day of the last week of the first day of the first month of 2022. I think I got it right. It's the beginning of the last week of the month. Where has this month gone? I honestly have no idea. I mean, I think we already had 2 holidays, 2 3-day weekends. I don't know. Januaries are always pretty quick to go by. It's about 7:46. The market's going to open up in about an hour and 15 minutes or so, give or take. Maybe a little bit more, maybe an hour and 45 minutes. I don't know. Not for a while. It doesn't open until 9:30. We're in Eastern time zone. As you can see here, the E-mini NASDAQ are down quite a bit. The Dow's down a little bit beyond random. I would like to say that this is a lot beyond random, but based on the volatility that we've been seeing in the last several weeks, actually not the last several weeks, last few weeks, I would say this is more or less random. But again, market's down after being down on Friday and last week. I want to talk about the calendar for the week, and then I'll get into the nitty-gritty, all right? So we've got a lot of Fed data, a lot of data to begin with this week. We've got FOMC meeting beginning tomorrow. I think the Fed is going to look back and say we may want to push back this aggressive interest rate hike because right now the market is really, I mean, just being deflated. And I don't think that's the goal of this exercise. We also have consumer sentiment, very important report. Personal income is not going to be as instrumental as GDP. GDP, the growth of this country, and FOMC are going to be the biggest reports of this week. I'm expecting the market to have a very different tone before the end of this week. I think the market is close to peaking out at the downside, and I think the Fed is going to clarify or backtrack some of their statements about increasing interest rates aggressively. I don't know why or how, but I think they're going to blame Ukraine. I think they're going to say COVID is getting better. I don't know what the hell they're going to do, but I think they're going to tell us that economy's not looking as bad or as good, and we're going to have to slow things down, because if they continue down this path, it's going to get very messy, very quick for the stock market. Anyhow, keep your eye on durable goods, GDP, the results of the meeting, and typically, beginning of the meeting, we have subdued market action. But in this case, we've got consumer confidence on Tuesday, consumer sentiment on Friday. I don't know what the hell the reason why would want to put consumer confidence and consumer sentiment so far apart. And in between, you've got GDP. I mean, honestly, I'd love to have a word with whoever puts this calendar together, because it's completely illogical. But no one's going to listen to me. I might as well write a letter and throw it in the garbage can. So we're going to have the Fed press conference. This is an FOMC announcement. This announcement right here and the GDP announcement is going to set the tone for this week. So be very carefully. I think this week is going to start out kind of slow, scary, but I think we're going to have a better ending. One of the biggest factors that's telling me that the market is overdone is the fact that the bond market has actually been moving higher, not lower. Bond market moving higher means interest rates moving lower. And that started about, let's see, 1, 2, 3, 4, middle of last week, beginning maybe Tuesday or Wednesday of last week. It started on the 19th. That was about 5 days ago. The point is, the last 4 sessions, the bond market has been moving higher. Remember, interest rates and bonds are inverse to each other. This is a very strong sign that, and remember, consumer discretionary and bond prices move together, because lower bonds, higher interest rates, more pressure on consumer discretionary. So consumer discretionary has been coming down, but last 4 days, the bond market's saying, hell with it, I can't go down anymore. And it's been going higher. That's a very positive sign, and something we haven't seen since beginning of this year. Very instrumental. Now, put the call ratio. Look at where the put-call ratio is at 126. This is only showing 111. We're at 126. We're up here. So if you look long-term, let's go 2 years. Look at this, 126. Look at this, 126. Folks, we haven't been to 126 since COVID. So we're either setting ourselves up for a big run, or we're about to have a shakeout. And I think we're going to have a shakeout, a nice big shakeout, which we need. But the bottom line is, with the With the put to call ratio being right here, there's just not much more we can do to the downside. The downside is limited. Also, if you look at the NASDAQ 100, and I've been showing you this, look at the number of stocks trading above the 50-day moving average. We're at 17.82% right now. Look at it on a 3-year basis. 1 time, 2 times. This is now. This is COVID crash. 3 times. Let's go further back. How often do we go? And even when we do break this level right here, look at what happens. We have a waterfall, 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 waterfall. We never ever, look at this, we never go to this level and stay here for a long time. And this is, I mean, I'm going back quite a while, 10 years on a monthly basis. 1, 2, 3, 4, let's see here, 5, 6 times. Let me go 20 years. This goes back to 2008, I believe. This is 12 years. On a monthly basis, we've been down here just a few times. So if we're not there yet, we're getting very, 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 very close. Let's talk about world economy, global economy, and then I'll look into chart patterns and I'll look at sectors for you. So shares were mostly lower in Europe, Asia, on Monday after Wall Street logged its worst week since pandemic began in 2020. And I'm telling you right now, folks, it looks like we're going to have another shakeout that looks very similar to it. I mean, here's the shakeout, here's the pandemic, and here's where we're at right now. We're breaking these levels. And I'm telling you, we're not going to sustain these levels for quite some time. Investors have been growing increasingly worried about how aggressive the Federal Reserve has been in their talk, but let's see how aggressive they are when it comes to action. They've been behind the ball for so long now, I'm not surprised if they would backtrack some of the things they've been saying. Some economists believe the Fed and other central banks need to move faster to tamp down surging prices by raising rates. U.S. consumer prices rose 7% in December compared to a year ago, biggest increase in nearly 40 years. Rising costs are raising concerns that consumers will start to ease spending because of the persistent pressure on their wallets. So that is a big, big fear. As I mentioned, this was the worst loss since March of 2020. That's the COVID period, when investors expecting the Fed to begin raising rates as soon as March. Costly shares in tech companies and other expensive growth stocks now look relatively less attractive. I'm not sure about that. Not sure about that. If you look at the indices, let me show you something interesting. A few things. S&P 500 is trading below the 200-day moving average. I want to show you something. On a 3-year basis, it doesn't happen very often. This is a weekly chart. Doesn't happen very often. On a daily basis, doesn't happen very often either. And the momentum level, the shift to go to the 200-day moving average has been very, very quick. It didn't take us a year to get there. We got there very, very fast. And typically when momentum levels decline this fast, they bounce back. We're at 18th percentile. I want to show you guys the last time we were here. COVID. This is the COVID crash. So when we typically come down this fast, the projectile is to move higher, not lower. And we went from overbought to oversold in, let's see here, in 2 months. And in this case, we went from overbought in 2 months too. Too much, too fast. Too much, too fast. This is too much of a downside. So I believe we're going to cool off on these levels. If you look at, and I wanted to show you this, and I showed you this again. If you look at the put to call ratio, the CPC, it's telling us, once again, and again, this is telling us 126. I don't know why it's showing 111, but we are really, 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 really oversold right now. Also, and this is important, one of the things that happens when the markets are cooling off is they get defragmented, or they get fragmented. Basically, what it means is, this is Friday, January 21st. I want you to see something. Let's go back a week ago. Look at where technology and consumer discretionary are. They're together, right? Let's go back another month. Consumer discretionary and technology are next to each other, right? Let's go back to today, and let's go back to the previous day. Look at consumer discretionary and look at technology. They're out of whack on Thursday. Typically, when consumer discretionary, they're like this, they're tight, they're best friends. When consumer discretionary and technology get out of whack and the market pulls down like it did on Friday, as you will see right here, and we cross the 200-day moving average to the downside, it causes, like right here, like we did, it causes these sectors. See Thursday, look at Thursday. Technology, consumer discretionary. Now look at them on Friday. That's basically today's data. Technology and consumer discretionary. They're not fragmented anymore. And they moved from all the way to the second spot to the almost the last spot. Now there's no fragmentation between communication discretionary, communication services, consumer discretionary, and technology. They're next to each other. That's a very, very important key to making the market go back higher. Markets are not fragmented anymore. You've got consumer staples with utilities. You've got basic materials with real estate and industrial. That's very much in line. You've got healthcare down here. But most importantly, you've got technology and consumer discretionary. That's telling me that the markets are ready to go higher. Now, when you look at the Dow Jones, let me give you some levels. We've got to use the Dow Jones as a gauge. We want to see the market go above the 350 level on the Dow or the 35,000 level. On the SPY, we want to see SPY go above the 4,421 level, or 442 if you're looking at the SPY, depending on if you're looking at the big index or not. And if you're looking at the QQQ, you want to see us go above 365.50. That's where, or 366 level. That's what we need to see right now. Now, in terms of stocks making new highs, let me show you stocks that are making new highs in the S&P. This is where the strength is right now. Ford, Conoco, Halliburton, Tesla, McPherson, Pioneer Natural Resources, Energies, and Ford, and Energies, and a couple of bank stocks, but mostly Energies. As far as the downside, spec stocks, Netflix. Well, Netflix is not as speculative, but boy, it sold off. Gap, Paycom, speculative names that were actually leading about a year ago, when we were first starting out, coming out of this COVID economy. So now you have all the natural resources and the big stocks. So my summary for right now is, I think as long as the bond market moves higher and not lower, that's going to be a very good sign for the stock market. I think if the put-to-call ratio is at 126, that's a very positive sign for the stock market. Everything is pointing to a higher stock market, even the fragmented sectors right now. So I wouldn't get too bearish right now. I want to see us, if we're going to go bearish, I want to see all this volatility cool off and us trade below the 200-day moving average on a consistent basis over the next week. And I don't think that's going to happen. I think we're going to go higher because I don't think we're going to stay at these levels too low. I think what's happening is the market is overreacting to this right here, to this bond price going down, especially the last few weeks. And even the bond market isn't reacting to it anymore. It's moving higher. And I think the stock market is going to start reacting to it. So right now may be a good time to start pause off, risk off, just sit tight and wait. Let's see if we can get above the 200-day moving average over the next few days, or if things move in the right direction. And remember, the Fed is going to shape, the economy is going to shape the trading action this week. There's a lot of things that could happen. If the Fed says, oh, we may hold off on increasing rates, that would be the biggest rally ever. So let's hold off on making any big decisions. Let's hold off on getting super defensive. We just crossed the 200-day moving average, and I think the market is grossly overreacting. Let's see how this week trades. Let's see what the GDP says. Let's see what the Fed tells us in light of the market being below the 200-day moving average, and the fact that we're below the 200-day moving average with crazy volatility and sectors are now becoming less fragmented is a very positive sign. So I know from the view of things are looking really bad, but from market internals, things are looking a lot better, a lot better. And it looks like we're going to be moving higher. There's a higher odds that we're going to be moving higher than lower from these levels. Sorry I'm taking so much of your time, but I got something important for you guys. And I'm telling you, if you're struggling with this market, I'm going to tell you this. We've all been there before. You buy the dip in your favorite stock, but then the dip turns into a correction, and then the correction turns into a crash, just like last week. All of a sudden, 2 to 3 months of gains are wiped out in 2 or 3 days. This is what we call blowing up an account, and we see new traders doing this mistake over and over again. The key is to use a built-in hedge for protection. You got to have a way to protect your account. Either use options or limit your risk or diversify or use stops or use a hedge. But you got to have some type of risk protection. The hedge allows us to take full advantage of all the gains. And when the market crashes finally, we're fully protected. During the COVID crash, our hedge, I think, made 449%. And our overall cluster made, I think, 60-something% during the COVID crash. I'm telling you, it works. This hedge allows us to take full advantage of all the gains. When the market crash finally does come, we're protected. Click the link below to learn more about how I plan to incorporate this strategy in 2022. This training is all meat and potatoes. You guys are going to love it. Follow the link below. And this week is going to be a very, very instrumental week. Follow the markets closely. If you guys want to send me an email, want to hear back from you, let me know if you guys are getting value out of this. support@marketgeeks.com. Follow the link below. Check out this training session. It's very timely and it's perfect for what's going on right now. Have a great week. Any questions? support@marketgeeks.com. I'm always there for you. Bye, guys.